Are you qualified to pay taxes or are you non-qualified to pay taxes when you roll your money over from a 401k, your IRAs, these different kind of accounts? I want to break this down because did a financial seminar this morning and I had a few appointments and people didn't know what qualifies them for paying taxes, what qualifies them for moving their money so it could be tax free. How can they not and how can they avoid that kind of stuff? We're going to break that down. So ladies and gents, just here to drop a few cents here with Earl, the money coach, being licensed for a decade in the financial industry and 2 decades of investment portfolio experience. Definitely want to break this stuff down. But before we get started, make sure you check the links in the description and you like, follow, and subscribe. So let's get to it. The terminology, qualified or non-qualified. This is what you hear when you want to move your money when you're doing a rollover. If you're doing a rollover like a 401k into annuities or a 529 into a Roth IRA, all these different kind of plans, you're going to hear the word rollovers, and then you're going to hear if it's qualified or non-qualified. Now, it's exactly what it sounds like. You're either qualified for taxation or it's not qualified to pay taxation. So what is that coming to? The main one most folks know is a 401k. If you have a 401k or a 403b or a TSP or a 457, a lot of these are tax deferred accounts, which means since taxation is deferred, once you start to withdraw, then you're going to incur actual taxation. Same thing applies when you're rolling your money over. If you're rolling your 401ks into your fixed index annuities, since that principal is qualified to be taxed, you're still going to have taxation once you move it into your annuities. Now, what does that look like? Let's say you have $100,000. You got $100,000 in the 401k. You want to move that. It's going to be at a tax bracket, so you got to pay $24,000 in that 401k. So you got $100,000, you got $24,000 in taxation. You have 2 options. Once you're rolling your money into, say, your annuities and things of that nature, you could either option A, take care of the taxation up front. You got $100,000, let's take the taxation out up front, and then $76,000 is going to actually be rolled over into whatever strategy you're using. So you have that option A, take care of taxation up front, or you have taxation B, option number B. You have that $100,000 come in from your 401k, put the whole $100,000 in, let that $100,000 accumulate. But when you start withdrawing, we always say last in, first out. Once you start to withdraw those funds, then you're going to have taxation coming out during the withdrawal process on that principal. So it's only on the principal. That's huge when you have tax advantage accounts, because a lot of these tax advantage accounts, your money gets to accumulate and grow tax free. I'm going to say that again. With a lot of these tax advantage accounts, if you have your index accounts, index annuities, index insurances, things of that nature, your money in those accounts get to grow tax free. Just like a Roth IRA, you pay a little bit up front and then everything else gets to grow tax free. If you had a Roth IRA, you're putting in $500 a month. $50 goes towards taxation up front. Everything else gets to grow tax free. Same thing happens with your annuities or your rollovers. You have your money, you may pay, like I said, a little bit up front if it's like a 401ks or anything that you're moving over, that penalty or taxation, on that 401k or on that money. You can either pay it up front or pay it down the road on that principal. So the example is if you have $100,000 you roll over from a 401k, for example, or IRA, you put that $100,000 into an annuity. That annuity goes from $100,000 to $500,000, okay? That $400,000 of growth has accumulated and accrued as a tax advantage, tax-free growth. But that initial $100,000 that you rolled over is still subject and penalty to actual taxation. If you're touching that money before 59 and a half, that's why I say a penalty, because fixed index annuities and a lot of these accounts as retirement accounts, if you touch it before 59 and a half, you're going to have a penalty. So you have, or you could pay a penalty, or you're going to have that taxation on your qualified funds, meaning it's qualified to be taxed. Now your non-qualified is exactly what it sounds like. You got $100,000 in your bank account. Well, guess what? From your job, it's already been taxed. From your CD or whatever, a settlement, all that stuff's been taken care of. So that is not qualified as a non-qualified to be taxed. So all that money gets to go in. You have 100,000 in your bank account. That 100,000 grows to 500,000. But guess what? Since it's already been taxed up front, everything gets to grow tax free. And that's how you could have your non-qualified funds. Now, how do you move this over? Generally speaking, there's something out there called a 1035 exchange. Now, a 1035 exchange is pretty much the paperwork that you use to initiate a transfer from one kind of account to another kind of account if it's on the same level. Meaning if you have a 401k to a 401k, an IRA to an IRA, a life insurance to a life insurance, that is a 1035 exchange where you can move everything from one account to another, which most of my clients, I have a lot of deals where I do a lot of that stuff for my clientele. But now, once you want to switch, say from a 401k to an IRA, from an IRA to an annuity, any of these kind of strategies, that's not a 1035 exchange. And that's when it'll either be most likely subjected to taxation or not. So make sure you understand these things when you're looking, because too many people, especially on social media, they say, oh, you got an IRA and you want to move that to a fixed index annuity and some of these different annuities. Well, guess what? You're not going to have to pay taxation. That is wrong. You have to pay taxation on the principal depending on how it was actually funded. If it's qualified funds that you're funding into your annuity or non-qualified, you want to make sure that happens, because too many times I'm sitting down with people who are misled. They thought that meant they move money into, say, your annuities and everything grows tax-free. That's not the case. So folks, just wanted to break down the power of knowing qualified versus non-qualified funds for taxation. That could save you time. It could save you a headache if you understand how this stuff works. So that being said, folks, you're here with Earl, the Money Coach. Make sure you like, follow, and subscribe, and I'll see you on the next video. Take care.